The S&P 500 forward 12-month PE multiple is at a high, 18.9% or thereabouts. But this market cap-weighted large-cap index valuation gets held up these summer days by 7 monster infotech stocks. Our chief equity strategist and economist John Blank is here now to discuss a contrarian call for value and income. John, first of all, which stocks are we talking about?
Well, we're talking about Facebook, Amazon, Apple, Netflix, Google, NVIDIA, and Tesla.
Okay, and how is the S&P 500 index getting held up by these infotech stocks?
Because they are all in the high 20s at least forward PEs, and they make up 30% of the S&P market weight. So you can get a 19 or PE when you put 7 stocks at 25 to 30 PEs.
I can remember not long ago when the tech sector was kind of languishing. Why is it kind of hot this year?
Because these monopoly or quasi-monopoly institutions are able to create growth where the economy creates some small amount of growth, but not double-digit growth. They have been able to exceed the metrics of the overall economy.
Where then does that put the 10-year valuation average for the S&P 500?
Well, keep it very simple. 17. So if we're at 19 roughly, and we can go to 17 roughly, that's 2 minus 2. So 2 out of, let's call it 20, is 10%. So the call here to worry about, valid call, is a 10% correction. I'm not making a recession call here. I'm making a correction call. And it's very uncertain when this can happen, or even if it does. But keep in mind, we have a 10% overvaluation on historic terms that are relevant.
So is this index valuation a bad thing for the market and investors?
For the short-term trader who can stay focused on those 7 big stocks, no. For those of us who want to put money to work in index funds at a market weight basis, yes. And for those of us who are investing in lower PE areas of the market that are underserved and overlooked, this is actually a good time to buy.
So against this backdrop, other S&P 500 sectors are being hugely overlooked and underbought. And one in particular is the materials sector, right?
That is correct, because everybody has been shorting the material sector on the weak growth in China, which is the world's manufacturing powerhouse and raw materials user. So the basic short here has been that China will not stimulate, and if they do, they will not stimulate in a traditional way through infrastructure. So material stocks will not get bid up.
After the latest momentum runs that were taken by the mega cap infotech names, is now then the time to buy those beaten down stocks in the overlooked S&P 500 sectors?
Well, I mean, yes. Again, if you're going to read some news over other news, that today, Wednesday, the July the 20th, or I should say yesterday, July the 19th, there was a 31-point plan put out by the Chinese leadership on how to stimulate growth. And that was echoed by all the tech billionaires in the country and other people. So again, if you want to be in at a low valuation and buy the rise of a material stocks, that's the contrarian bull play at the moment.
Okay, that is the contrarian call that I mentioned at the outset, right?
Correct. Yes. You can buy either Chinese tech stocks, materials companies, or indexes that are weighted to this part of the world on a diplomatic ice breaking or a turnaround in domestic stimulus, or just simply momentum trading in the Chinese market domestically overall. Those are the ways this type of trade could play out.
Looking at July sector rankings while we're on the subject, consumer discretionary and consumer staples stay very attractive, as well as industrials. And number one stocks in those sectors include Urban Outfitters, Kimberly-Clark, and Siemens.
Yeah, let's talk about these names because they do a good job laying things out. Urban Outfitters, of course, is the consumer. And we've got a stock here that's $35 a share, making $3 a share in earnings next year. That's a 12.5 PE, Terry. That's a decent entry at a decent valuation. So there's a trade like we're talking about with a 12.75 PE that I'm looking at. That's much lower than the average of the S&P at 17, and not at all near where the big 7 tech stocks are. Kimberly-Clark, another great name. This one in consumer staple stocks. I got a PE of 21.6 staring at me. And this is companies that make $7 a share in earnings right now. You can buy it at $135. A little bit of a momentum trade here too, as well. It's gotten a bit of late, so worthy of a look, just to save yourself from being in the wrong place when everything turns over. And by the way, you get a 3.5% dividend on a stock like this. Siemens, this is the big German conglomerate. I'm looking at $6 a share next year, and again, a PE ratio of 14, Terry. So here we have three stocks, and I'll go through them again just from a PE perspective: 12.75 PE. 21.6 PE and a 14 PE. That's my point here. There's lots of overlooked stocks at lower PE valuations.
Our chief equity strategist and economist, John Blank, talking about S&P 500 sectors. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.